clock reads 6 in the morning, and Ryan has already been up for a while. Two monitors throw pale light across a dim room. A cup of coffee sits forgotten and cooling next to his keyboard, and his hand hovers over the mouse as he hunts for the one trade that's finally going to flip his life around. On the other side of the city, Sam is still fast asleep, and Sam happens to be the one who's going to come out ahead. Here's the part that throws people off. Ryan is about to pour more effort into building wealth than nearly everyone he knows. He'll study every chart pattern that exists, memorize every technical indicator, and dump thousands of hours into those two glowing screens, and the entire time the odds are quietly stacked against him. Sam, who is basically going to do nothing, is the one statistics favor. I'm Nick, and I've spent way too much time watching people mistake motion for progress. So if you've ever asked yourself whether day trading is a genuine road to wealth or just a fancy method of handing your savings to strangers, stay with me, because today we're crunching the real numbers for both paths, and the distance between where they end up might catch you off guard. Let's keep this fair, because these kinds of comparisons usually get rigged from the start. Ryan and Sam are both 28 years old. Both bring home $55,000 a year. Both have $30,000 sitting in savings. Same town, same rent, same exact starting point. The only difference between them is what they choose to do with that money, and even more importantly, what they choose to do with their free time each evening. Ryan comes across the idea that day trading is how regular people break free from the daily grind. So he takes his $30,000, spends $1,500 on a trading course, sets up his dual monitor station, and starts trading before his day job begins. During lunch breaks, and again, late into the night. Sam reads somewhere that almost nobody consistently outperforms the market, shrugs it off, and puts his $30,000 into a broad market index fund. He sets up an automatic $200 monthly contribution and more or less forgets the account exists. On day one, the two paths couldn't look more different. Ryan has an entire setup, charts lighting up two screens, a watch list, a trading journal, and a Discord server packed with guys using rocket emojis as usernames. When his friends ask what he's been up to, he gets to answer, "I trade." People perk up. It sounds impressive, like a real skill. Every time he closes out a profitable trade, his app bursts into little confetti animations, and something in his brain fires off like a slot machine hitting a payout. That feeling is really the product he's buying. Sam, meanwhile, has a confirmation email. That's the whole experience. When his friends ask what he's investing in, he says an index fund and watches their eyes glaze over. Nobody's particularly impressed. There's no rocket emoji for, "I bought a slice of the entire market and went to sleep." Here's the trap the whole story hinges on. Ryan's path feels like he's winning. Sam's path feels like giving up before he even starts. But feelings and mathematics are two completely different creatures. One of these two is generating activity, and the other is generating actual progress. And our brains are wired to mix the two up because activity is loud and progress happens in silence. The market doesn't compensate you for how hard you try. It compensates you for having an edge, and it charges interest on every bit of activity you generate. Hold on to that thought, because we're about to watch both bills come due. So let's start the clock running. Year one. And to be fair, year one is exactly where Ryan's story shines brightest. He catches a hot streak. A handful of tech stocks take off, he rides them up, and by spring, his $30,000 has grown to somewhere around $38,000 or $40,000. He's outpacing Sam. He's outpacing the market itself. He posts a screenshot of a green trading day in the group chat, and for a few glowing months, he's living proof that every skeptic was dead wrong. Meanwhile, Sam's balance has crawled from $30,000 up to roughly $35,000, mostly thanks to the market drifting upward, along with his steady deposits piling up. It's slow, it's dull. And right at this moment, if you pause the tape, you'd swear Ryan made the smarter call. Remember this exact point, because this is as high as Ryan's story will ever climb. He has no idea yet. To him, it feels like the beginning of something big. This is the moment course sellers love to screenshot. The flashy car in the driveway, the "I quit my 9 to 5 at 28 thumbnail, and for a while it's genuinely real. But flipping heads 5 times in a row can feel like skill too. It isn't. The traders who win early are actually in the most danger because the market just handed them exactly the wrong lesson at exactly the worst time. By year 3, the coin starts landing tails again and again. That early hot streak reverses the way hot streaks always do, and Ryan hits a rough patch where he tries to claw back a loss and only digs the hole deeper. Traders have a name for this: revenge trading, and it works about as well as it sounds like it would. There's one particular Tuesday in March that still haunts him. He was down $400 by lunchtime, so he doubled his position trying to win it back quickly. Then he sat frozen, hand glued to the mouse, watching the position collapse while telling himself out loud that it had to bounce back. It never bounced, but that single afternoon cost him $1,100 and a week of sleepless nights. And the money wasn't even the worst part. What stung most was knowing the entire time that he was violating his own rules and doing it anyway. After 3 full years of treating this like a second job, his $30,000 is worth roughly, $30,000. Maybe a bit less once you factor in the course fee and the couple of months he essentially donated to the market while learning what a bull trap actually feels like. Sam, on the other hand, hasn't checked his account in ages. When he finally does peak, it's sitting somewhere around 47 or 48,000. He was, by any fair measure, completely disengaged the whole time, and he's now $17,000 ahead of the guy treating this like a full-time career. Here's the thing, though. Ryan isn't unlucky. Ryan is completely typical, landing exactly where the research predicts he should. And the data isn't even close. Researchers in Brazil followed everyone who began day trading over a 3-year stretch. Among those who stuck it out past 300 days, the truly committed ones, the Ryans of the world, 97% lost money. Not underperformed, lost outright. Roughly 1 in 100 managed to earn more than minimum wage doing it. Over in Taiwan, economists analyzed the complete trading records of an entire exchange spanning 14 years and discovered fewer than 1% of day traders could reliably turn a profit once costs were factored in. And in the United States, the most active traders, the ones putting in the most effort, trailed the market by roughly 6.5 percentage points annually, year after year. So when Ryan finishes year 3 right back where he started, that's not bad luck. That's the median result. The activity itself is what's draining him. Every single trade carries a spread, that tiny gap between what you pay to buy and what you get to sell. Pay it once or twice, no big deal. Pay it hundreds of times a year while competing against machines that spot price movements and react before light even finishes traveling from your screen to your eyes, and you're essentially operating a business whose only devoted customer is your broker, who happens to think you're doing wonderfully and sincerely hopes you'll keep going. And that doesn't even count the cost that never appears on any statement: the hours. This is where it gets genuinely painful. Let's tally it up. Ryan trades somewhere between 30 and 40 hours a week, roughly 2,000 hours a year. Over 5 years, that adds up to somewhere between 7 and 10,000 hours of his one and only life spent glued to screens. Sam spent about 1 hour total setting up an automatic deposit, which technically makes him the highest paid person per hour in this entire story. And he was asleep for most of it. Let's check back in at year 5. Sam's account has climbed to roughly $63,000, and the shape of that growth curve is shifting. It's no longer creeping, it's beginning to bend upward. Compounding stays boring for the first stretch, and then quietly transforms into something enormous. The gains start producing their own gains, and Sam's money is now earning more each year than he personally contributes. Ryan, meanwhile, belongs to a different statistic by this point. Only about 15% of day traders are even still active after 3 years. The rest quit, blew through their accounts, or drifted back to conventional jobs with a considerably more skeptical view of trading Discord servers. So if Ryan is still in the game at year 5, he's technically a survivor, but surviving and winning aren't the same thing. And becoming Ryan has never been easier than it is right now. For more than 2 decades, one safeguard quietly protected beginners from themselves. To day trade actively, you needed at least $25,000 in your account. But that protective barrier has been eroding lately. Between offshore brokers, prop trading firms, and new high-leverage products flooding the market, it's never been simpler for a newcomer to sidestep the old rules and wipe out an account with only a few $100s. By year 10, the two lives aren't even comparable anymore. Sam's balance has crossed $116,000. He personally contributed $54,000 of that total, and the remainder is pure compounding. He did nothing to actively earn. He's picked up promotions, taken vacations, lived his life, and in the background, his money has quietly outperformed a man working full-time trying to beat it. Now, a serious day trader watching all this has a legitimate pushback, and it deserves real consideration, because if I only criticized one side, I'd be no different than the people selling courses pointing the opposite direction. The pushback goes like this. Sure, most day traders lose, but the elite ones win. Skill is real, and that's actually true. The Taiwan research did uncover a small group whose skill held up even after costs. Skill genuinely exists, but here's the catch with betting your entire future on landing in that tiny group. Look at the professionals, not bedroom traders, but the actual pros with Bloomberg terminals, research teams, and economics PhDs behind them. Every year, a scorecard called SPIVA measures how many of them outperform a simple index fund. Over the past 20 years, roughly 92% of them lost to it. Sit with that for a second. People armed with Bloomberg terminals and entire research departments losing to a fund you could set up on your phone during a coffee break. And if you wanted even more blunt, Warren Buffett once wagered $1 million that a plain index fund would beat a hand-picked selection of elite hedge funds over 10 years. He won so convincingly, the other side threw in the towel early. The index returned around 7% annually. The expensive, celebrated hedge funds returned about 2%. So when Ryan tells himself he'll be the exception, he's not really competing against other beginners, he's competing against these seasoned professionals and losing to the very same fund they lose to. Now let me flip this around, because index investing isn't some risk-free miracle either. Sitting through the market takes real nerve. In 2008, the fund holding Sam's money dropped 37%. Over a third of his wealth vanished on paper within a matter of months. Think back to early 2020 when it fell nearly that far in just a matter of weeks. And we've watched plenty of similarly gut-wrenching drops in the years since. Sam felt that too. During that crash, he opened the app for the first time in ages, saw the number staring back at him, and sat there with his thumb hovering over the sell button. Every instinct screamed at him to get out. He didn't press it. That's the entire heroic act right there. A guy sitting on his couch, choosing not to press a button. And that single choice was worth more than every trade Ryan ever made combined. Because an index fund only pays out that long-term average if you actually stay put, and most people simply can't. Study after study confirms that the average investor significantly underperforms the very fund they're holding, panic selling near the bottom and buying back in near the top. They leave half their potential gains on the table simply by flinching. So Sam's real advantage was never intelligence. He isn't smarter than Ryan. His entire edge was doing absolutely nothing while his gut screamed at him to act. That's the whole game, and it's just as hard as day trading, only in a completely different way. There's one more cost working quietly against Ryan too, baked directly into the tax code. When Ryan profits from a trade he held for a few hours, the government classifies it as a short-term gain and taxes it just like ordinary income at his regular rate of 22 to 24%, sometimes higher, skimmed off every single winning trade every single year. When Sam eventually sells, years down the road, it counts as a long-term gain, taxed at a lower rate, often around 15%. And Sam pays absolutely nothing until he actually sells. His gains compound untouched for 2 decades straight, while Ryan gets taxed the same spring he earns the money, shrinking the very pile that's supposed to be growing. So even in the fantasy scenario where Ryan turns a real profit, say he nets $20,000 in a fantastic year, he hands a hefty chunk straight to the government after burning 2,000 hours to earn it, while carrying risk Sam never had to touch. Run those numbers and his effective hourly income can quietly drop below minimum wage. And come tax season, Ryan's return looks like a crime scene. Hundreds of trades, wash sale adjustments, a spreadsheet that has trust issues of its own. Sam's tax return is a non-event. He sold nothing, so there's nothing to report. The tax code isn't neutral here. It quietly rewards the person sitting still and penalizes the one grinding away. So let's jump ahead to the finish line this whole story has been building toward. Year 20. Sam never became an expert. He never learned to read a single chart. He just kept buying the boring fund and refused to panic. His account now sits somewhere between $250,000 and $340,000. He personally put in about 78,000 of that total. The remaining $250,000 or so is pure compounding, money that appeared simply because he left it undisturbed. Ryan, 20 years in, the overwhelming odds say he stopped trading years earlier, either quietly or painfully. And if he had simply taken that same $30,000 and dropped it into that same boring fund on day one, he'd be standing in exactly the same spot as Sam today, except he'd have 10,000 extra hours of his life back. Does day trading ever actually make sense? In a handful of specific situations. If you approach it like a real business with a genuinely tested edge, risking only a tiny fraction per trade so variance can't wipe you out. If you're using it as training toward a real career, a prop trading firm, a quant desk, somewhere it becomes an actual job with a paycheck rather than a lottery ticket. Or if you're using money you've genuinely decided counts as entertainment, a small slice you can afford to lose the way some people spend money on golf. Day trading isn't inherently evil. It's just a job with a 99% failure rate that markets itself as a shortcut. And notice who's the one person in this entire story reliably getting rich. The guy selling the $1,500 course. He really is raking in money, just not through the method he claims. His edge was never the market. His edge is you. But that was always the real trap, and it was never actually about day trading versus index funds. Ryan and Sam both assumed they were answering which approach makes more money. That was the wrong question from the very beginning. The real trap is believing the effort you put in should match the payout you get out. Because in investing, that relationship often runs in reverse. The market doesn't hand out rewards for trying hard. It hands them out for being right and being patient. And patience looks a lot like laziness right up until the moment it starts looking like genius. Here's what nobody selling you a course will ever admit out loud. The single most sophisticated financial move available to an ordinary person, the one that outperforms the vast majority of professionals, is simply buying the entire market and refusing to touch it. It's almost embarrassingly simple, and that simplicity is exactly why people talk themselves out of doing it. It doesn't feel like enough. It doesn't feel like winning. And if part of you is thinking there has to be some middle ground, some sane way to scratch the trading itch, without setting your future on fire, you might be onto something real. So, next time someone shows off their trading screenshots or tells you index funds are for people who've given up, ask them one question. Not how much did you make, but how many hours did that cost you, and did you actually count them? Because the guy who did nothing, who bought the boring fund and got back to living his life, wasn't being lazy. He was getting paid in the one currency day traders always forget to track, the time they never get back. Ryan spent 10 years trying to beat the market. Sam spent 10 years ignoring it entirely. And the market quietly, patiently rewarded exactly one of them.